This is a video that wasn't planned, but after the news over the weekend about escalating tensions in the Middle East, I've already had people messaging me saying, Craig, what does this mean for mortgage rates? And honestly, it's a really good question because it highlights something that most borrowers don't realise. Mortgage rates aren't just driven by the Bank of England. They're influenced by global events too. So let's talk about what's happening, why markets react so quickly, and most importantly, what this could mean for borrowers over the coming weeks. And if you find this helpful, don't forget to subscribe because I break this type of thing down every week in plain English. When major geopolitical events happen, markets move into what's called a risk-off environment. Now that basically means investors get nervous. Money tends to move into safer assets, things like government bonds, the US dollar, and precious metals like gold. At the same time, oil prices often rise because markets start worrying about supply disruption. And here's the key part. Higher oil prices can push inflation higher. Not inflation today, but expectations of inflation tomorrow. And financial markets price the future, not the present. This is where mortgages come in. Fixed mortgage rates are largely priced using something called swap rates. Swap rates move based upon what markets believe interest rates and inflation will look like over the next few years. So, if markets suddenly think inflation could rise again because energy prices increase, swap rates can move very quickly, and for reference, they are already up this morning. And when we see swap rates move, lenders reprice mortgages, sometimes within days. That's why mortgage pricing can change even when the Bank of England hasn't done anything. It's not just UK economics, it's global sentiment. Now in the short term, markets can actually move in both directions. Sometimes you can see swap rates fall as investors rush into bonds for safety. But if inflation fears start dominating, especially through higher oil prices, swap rates could rise again. And lenders hate uncertainty. So during volatile periods, we often see mortgage pricing become much more cautious. Not necessarily dramatic increases, but fewer aggressive rate cuts, and sometimes even upward pricing. And this then brings me to the biggest mistake that I see borrowers make, trying to beat the market. People delay decisions because they think rates will fall next month, or they rush into something because they think rates will spike tomorrow. But the reality is nobody, not brokers, not lenders, not economists, can consistently predict short-term market moves. One unexpected global headline can completely change expectations overnight. So choosing a mortgage should never be about guessing where rates might go next. It should be about certainty, your affordability, your plans, your risk tolerance, because the right mortgage is the one that still works if markets move against you. So if you're buying or remortgaging right now, the message is simple. Yes, markets may become more volatile. Yes, mortgage pricing could react. But don't base life decisions on headlines. Base them on a strategy that works for your situation, regardless of what markets do next. That's how you remove stress from the process. If you've got questions about how current market conditions affect your own mortgage plans, please feel free to get in touch or drop a question in the comments. And if you want weekly updates explaining what's really happening with mortgage rates, don't forget to subscribe to the channel.